And so when I was showing you my 3 investment holdings, it brought me back to some of the Cambria research with my man, Faber here. And it brought me back to a couple articles I want to go revisit and show you, because this one right here, the dividend growth myth, is superior. It's a superior piece of writing, a superior piece of evidence, so to speak. It's fundamentally fantastic for any investors who are considering how to invest their money. So let's dive right into this. Welcome to Heritage Wealth Planning. Don't forget to subscribe. And, of course, comments, thumbs up, the whole thing. All right, so there's my man, Meb. Listen to his podcast. All his books are available for free. The reason for that is because Amazon had a lot of fakers that were selling his books on Amazon, and Amazon had no way to police it. And so he said, I'm just going to give them away for free. So you can buy all his books for free, which you should. All right, so we're going to read this. This is just dated, going on 2 years ago now, but I'm telling you, I can read this verbatim because it's that critically important. Excuse me. I'm going to get some of my Walmart Clear pineapple coconut drink. This stuff's good, man. This Clear stuff from Walmart. Nah, this is the Zero Clear, but man, that's some good stuff. Pineapple coconut. I love pineapple coconut. And I even drink alcohol. A few weeks ago, I was sipping coffee, thumbing through Barron's as I do every weekend. It's a way in which I keep a pulse on what's going on in our space. Though I never consciously pay attention to the ads, on that particular morning, one caught my eye. A big full pager from Charles Schwab that you can see below. They were trumpeting their low-cost trading commissions and the ongoing fee compression in the investment management space. Since this ad, Schwab and others have since continued to lower cost, with Schwab now down to $4.95. And you can see right here is $6.95. Now it's down to $4.95 just from 2 years ago. For anyone having trouble seeing that ad, it favorably compares Schwab to Fidelity, TD, E-Trade, Scottrade, and Vanguard. All right. First, that is great news for all investors, and it's certainly huge progress from what brokers used to charge. Look at this old Schwab commission schedule below, $26 plus a 1.6% principal fee. And they were bragging then that there were low commissions. Sheesh, I'd hate to see high ones. And there's the old, I don't know if he says what, I'm not sure what year. Let's just curious to see if he'll give us the date on the ad. That's too bad. Anyway, remember, Schwab, to their credit, is one of the reasons that we have low brokerage fees. And guess who got rid of the trade regulations on brokerage fees? Jimmy Carter with Ted Kennedy, getting rid of trucking mandates and opening up to competition brokerage commissions too. Isn't that interesting? And Schwab is the first team there to benefit from that. Anyway, that's not the point of my article. A few pages later, there's another ad, this time from Interactive Brokers. Click to enlarge. Now here you see $2.26. In case you're having trouble seeing the details, the Interactive Brokers ad largely mimics the formatting of the Schwab ad, except it includes his own pricing in the chart, which Schwab had featured so proudly just pages before. Unfortunately for Schwab, Interactive Brokers pricing is the easiest of the lowest. Isn't that pretty interesting? So here's Schwab's ad. And notice they do not have Interactive Brokers. They got Fidelity, TD Ameritrade, E-Trade, Scottrade, and Vanguard. And then we go down to Interactive Brokers, Fidelity, TD Ameritrade, E-Trade, Scottrade, Vanguard, and Schwab. I love it. Capitalism, baby, is awesome. Unfortunately for Schwab, Interactive Brokers' pricing is easily the lowest. That's some pretty impressive trolling from IB. I chuckled at this a bit and honestly was surprised Barron's let it run. Though to be fair, I haven't seen it since, so I'm guessing the ad and maybe the account rep got the axe after the issue. Why? It's nuts. But I guarantee you Schwab pays more for the Barron's advertisements than Interactive Brokers does. But it brings up a good point. A comparison is only as good as a universe you decide to include. Schwab only looks like the best because they conveniently decided to omit the brokerages that charge lower fees. Now, to be fair, IB, Interactive Brokers, did the same thing. In its comparison, it omitted Robinhood, which charges no dollars for trade. But this article isn't about fees. It's about comparisons and the damage that misleading comparisons can do to investors and their core investing beliefs. So let's apply this point to a common investing belief involving dividend growth stocks that's likely far more present on your radar. I can't tell you how many times I've seen the following graphic, and I'm sure you have too. If you're on the podcast, you can't see this, but just Google dividend growth into Google, and you will see, it's so the S&P, so for those of you on the podcast, they have this chart. The S&P 500 index dividend growers have outperformed over time. Hypothetical performance of $100 invested in each of these 5 strategies going from 1972 to 2013. Dividend growers, all dividend paying stocks, dividend payers with no change in dividends, non-dividend payers, and dividend cutters or eliminators. And what you'll see is the dividend growers, $100 in dividend growers grew to $6,000 at the end of 2013, whereas $100 grew or went to $99 from dividend cutters or eliminators. And basically, dividend growers just smoked everything else without question. Dividend payers did grow to $4,131, so that was still good, but non-dividend payers only grew to non-dividend payers only grew to $99. There's a dividend cutters even that grew to $264. So that is the chart. I've seen this chart a million times. I've seen people try to push this to me myself, as a matter of fact, my friends, where you got to have dividend growers because look at this chart. The takeaway is simple. Invest in dividend growth stocks. And usually this piece is tied to a marketing for a dividend ETF. There are over 100 now, says my man Med. Or a dividend mutual fund. God knows how many there are of these. So what's wrong with the pictures? After all, dividends have a great brand and tell a great story. The problem is it's incomplete. Frankly, it's a Schwab versus Interactive Brokers versus Robinhood, just in different clothing. I partner up with our good friends at Alpha Architect. I'm a huge fan of Alpha Architect. I forgot the dude's name there, but he was a combat vet and went to West Point. Wes Gray, I think. Wes Gray. Man, if you want investing research, Meb and the boys over there at Alpha and our boys and girls at Alpha Architect are fantastic. Wesley Gray, I think. I didn't know he's got a PhD, but he is a combat Marine and something else about him too. I can't remember. He's phenomenal. I love his stuff. I don't read as much as I used to. I should. And had Jack Vogel run some simulations on dividend stocks for us. Here's what we found dating back to 1982. Results are similar to 1972. All right, so from 1982 to 2015, market cap weight, the top 3,000 stocks averaged 11.64%. All dividend stocks averaged 11.89%, and dividend growers averaged 11.54%. Equally, all the top 3,000 stocks average, and top is basically the Russell 3000, the largest stocks in the United States, average 11.59. All dividend stocks average 13.61. Dividend growers average 13.58. So market weight is the S&P 500. Equal weight is just saying we're taking 3,000 stocks, we're dividing by each are going to have one of 3,000 of a representative of the overall weighting. The S&P 500 is different. It's a market cap where the largest have the biggest representation. That's sort of at odds with the above chart, right? Where the dividend growers were up $100, grew to $6,000, and dividend payers with no change in dividends only grew to $2,000. Yet we're seeing similar numbers here from 1982 to 2015. It turns out that Ned Davis, who we love more than any quant shop on the planet, had been calculating the returns in a different way than what we're currently used to. The Ned Davis statistics are based on geometrically weighted indices. When they created them over 15 years ago, geometric indices were common. However, the industry has shifted to arithmetic indices now. One of the reasons that geometric means suppress the performance of outliers. 2 years ago, Ned Davis introduced arithmetic-weighted dividend charts. Now, with his updated return calculations, Ned Davis shows dividend growers returning 12.89%, all dividend stocks 12.83%, and equal weighted S&P 500 12.35% since 1973. So an entire generation of funds was sold on the premise of dividend growth outperformance. The problem is it's misleading because it doesn't tell the whole story. If you did a simple sort on high dividend yielders, top quintile, you would find they outperform dividend growth, sort of like the Schwab Interactive Brokers example. And again, we're going to show you the high yield dividends did 13% on a market weighted, and they did 13.96 on an equal weight. Okay. Not sure if you believe me. Okay. Here's a great piece by Have you ever seen that Key and Peele with the guys at school? I got to put a link. Oh, that is the funniest thing where you got this guy from the inner city teacher. He's like, I come from the inner cities. That's like, uppity school in the suburbs. He goes, Shug Nassack. Oh my goodness. It is the funniest thing I've ever seen in my life. All right. So anyway, market cap weighted. Top 3,000 stocks average 11.64. All dividend stocks 11.89. Dividend growers 11.54, and then high yield 13%. So you're saying, oh, high yield funds did better, high yield stocks did better, or high dividend stocks did better. Yeah, it'd be true, but not much. All right, so that adds details to the same conclusion. Dividend investors who do better by focusing on dividend yield rather than dividend growth. Okay, so basically what they're saying is, the higher the yield the dividend did better than the higher the growing. So you get a dividend pays 5% did better than one that starts at 4, pays 4.5, 4.75, and grows higher, if that makes sense. Okay, so simple high yield beats the growers, but I think you know I'm going with this. Sort of like the late night, but wait, there's more infomercials. You likely know by now how nonsensical I believe dividend investing is, and Meb does. I think it's one of the most basic mistakes retail and pro investors alike make. But I've written a book on this topic as well as countless blog posts. I won't repeat my reasons here, but here are a few links for anyone who's interested. But let's return to our theme of what's missing from the comparison. In Schwab's ad, it conveniently ignored Interactive Brokers. In Interactive Brokers' ad, it conveniently ignored Robinhood. What are the various marketing pieces of these dividend funds ignoring? They're all ignoring how companies distribute over half their cash flow to investors through buybacks. Once you take a more holistic view of cash distributions, which we call shareholder yield, the picture changes again. Now, note the significant outperformance in the chart below achieved through a shareholder yield approach, top quintile, which includes accounting for both dividends and net buybacks. Shareholder yield smoked the top 3,000 stocks, smoked all dividend stocks, smoked dividend growers, and smoked high yield, the shareholder yield. Now, what's shareholder yield again? Again, we're going to talk about that. We call it basically what we're doing is we are using half the cash flows through buybacks, not just dividends, but also buybacks as well to get shareholder yield. And when you factor in that, Meb's group says the shareholder yield smoked all the other things as well. Pretty impressive, right? We recently put out a new white paper, Think Income and Growth Don't Exist in the Market. Think again, documenting this outperformance. But anyone who's followed me for a while has known about this outcome for a far longer time. So next time you see a marketing piece for any strategy, think to yourself, what better comparison are they omitting? And here's the strategy using high dividend yield, or you can't see the podcast, but it's showing shareholder yield versus high dividend yield versus dividend growers versus no dividends and versus the uniform. And just as an FYI, as an FYI, the shareholder yield aspect smoked all the other. Postscript, for those who think this is just a small cap phenomenon, again, that would be equal weighted. Here's the top 500 stocks and the exact same thing. So if you got market weight, for the shareholder yield. So basically what's going on here is a lot of people say when you're using the Russell 3000, a lot of those are going to be small companies. And when you do equal weighting of the Russell 3000, the smaller companies are going to have more upside potentially, which would give you more of a potential growth than the larger companies simply because you're overweighting smaller in value, and historically small value does outperform. So when doing the market cap weight, you're taking that away, the favorability towards the small and more value-oriented stocks, which generally is dividends. And so we're doing market weight, and even their shareholder yield smoked it. A lot going on there. You need to look at this article. I love it. And I'm going to follow up with another article Meb has done on do you pay taxes and avoid dividends and do this instead? We're going to talk about that next. So don't forget to subscribe down below, my friends. Cambria, mebfaber.com is where you can find this piece, and I'll link to the show notes. We'll see you next time. Thanks.